you know?
Hey everybody, welcome. If you have any questions regarding improving your credit, please type them into the chat and we will definitely get to them. Also, you can ask them live. We're going to get started in just a minute. Today's session is all about improving your credit. We're so glad you guys are joining us. We're recording this for our YouTube page, so this will be posted there later, as well as all the other resources, home buyer seminar, investing seminars, everything else we have at The Collective Realty on our YouTube page. So make sure to check that out as a resource. We're just going to get started in just a minute. And again, if you have questions, please type them in the chat. And you're also able to raise your hand and we'll call in you as well throughout the session. The way we're going to kind of run it is Austin and I are going to ask a few questions that we've been hearing from a lot of our clients about credit and how to improve it and just generally what's on your credit and so on. After that, we'll open it up to you, the audience, to answer questions and to ask anything you want as well. So I guess, why don't we just go ahead and get started? I'd like to just start by introducing myself. I'm Anthony Volin. I'm the owner of The Collective Realty. We're located in West Hollywood and we serve the greater LA area in Southern California. We have a great team with us today. We have two lenders who are just really, really amazing. We have Natalie Salins with Movement Mortgage, and we have Marty Carey from Arcstone Financial. They're both lenders who I've used and worked with for a long time. And we brought lenders on today for you to answer these questions who really see day to day how credit changes and what affects credit and know the ins and outs of credit much more than we do on the real estate side. We've learned quite a bit, but as you can imagine on the lending side, they're dealing with this every single day. So they're going to give us some really great insight on different tips to improve your credit. And again, any kind of questions you have as well, we'll be able to get to that. So why don't we just start with kind of the first general question. What makes up your credit? You know, a lot of people ask, is my electric bill or cable bill or cell phone bill part of my credit? What if I'm late paying my cell phone bill? Is that going to affect my credit? So what actually is on your credit report?
So credit is interesting. Most of the time, I'd say 95% of the time, the only thing that shows up on credit are the debts that you owe somebody, right? So credit reports, the FICOs report how well you paid debt. So normally what shows up on a credit report is going to be limited only to student loans, car loans, credit cards, and mortgages. Because what do those give you? Those give you a loan that you have to pay back over a certain amount of time. What you don't find on credit reports, which most people don't realize, is that what you won't find on a credit report is your cell phone bill or a utility bill, unless you self-report them, or you know, a Wi-Fi bill, things like that are paid to zero every single month. They don't show up on a credit report because you pay it to zero every month. You're not actually borrowing money from somebody. That's normally what will show up only on a credit report. Very rarely does like a rental show up, like a management company's rents. That's kind of odd, but occasionally that will show up on a credit report and will kind of report a verification of rent on a credit, but that's rare. That's pretty rare.
Okay. And Marty, like what are some of the worst things that could happen to your credit? Like what things affect your credit score at the highest level?
So the most important thing is your repayment history is the highest effect on your credit report. So if you've got, you know, credit, like credit card or car loans and whatnot, you know, it's really important to make sure that those are paid on a timely basis because missed payments will definitely affect your credit at a higher level than having a high balance on your credit card, on the line of credit and whatnot. So those are things that are going to be not rated as high as your repayment history. So if you've got, you know, debts on a monthly basis, making sure that you're actually paying them back on a monthly basis on time is the most important factor of building up your credit. And, you know, that's why they say, you know, if you get a credit card, just charge a little bit and repay it back. That just shows that you actually are responsible. You get debt, you pay back debt on a timely basis. there's 5 factors that build up your credit, and that's going to be, your payment history, how much you owe, your credit mix, if you've got new credit, and then length of time of your credit report as well too. So having a credit report that has 2 years, 3 years, or even 10 years, as the years go on, your credit is rated in that manner, basically. So there's really 5 factors they're looking at when they're looking at comprising your credit scores.
So credit, I mean, for us, we're in the real estate business, and we obviously understand that the higher your credit score is, the lower your payments will be because your interest rate is less. But what other things does it affect besides just when you're buying a home? Who else is looking at your credit? Why is it important to keep our credit high at a high score, keep improving it, just be aware of what your credit is? Like, what are who else checks credit? Why is it important?
If you get a car loan, so they'll check your credit for any car loan. Honestly, anybody who you are going to potentially borrow money from is going to check your credit, right? So if you want to rent a house, or an apartment, your credit is going to be checked just for the rental, because they want to see a history of good standing. They want to know that you're somebody who can pay their bills in a monthly fashion and pay them, like Marty said, on time without derogatories, is what we call when you have lates. It's called a derogatory.
Yeah, I was telling a friend, just recently, he was thinking of leasing a car, and his credit score was like 625. I said, hold on. If you can wait a few more months and get your credit score up, let's take a look at that. You will actually have a lower car payment that you have to make. And he didn't really understand that or realize that. He's like, so I'm at 625. If I go to 700, my actual lease payment's less. I thought your lease payment is just one price. And I'm like, no, there's interest rates that you're paying for credit cards, for car loans, for car leases, for buying a home. It's the same thing. So getting the best credit score possible is going to save you so much money in the long run. And that's why we're talking about this today, because it affects every aspect of your life, right?
Right. I always tell clients, like, what does a credit score show? It shows strength in a file. If you have a weak credit score, now there's risk. What comes with risk? Higher percentage rate. It's like insurance. If you're living in Florida, your hurricane insurance is extraordinarily high because of the risk factor. If you're in LA, sometimes fire insurance can be higher, or obviously earthquake insurance is higher because the risk is higher. So higher risk, the higher you pay. And it's the same thing with credit. If your credit is low, now the risk level on a file is higher, and now you will have to pay a little bit more because they're going to build that risk into the rate.
So I wanted to bring in Austin, who's one of our top amazing agents at our office at The Collective. And Austin has really grown a lot of relationships through TikTok and has done some awesome live sessions. And he's getting hundreds and hundreds of people watching his live sessions, and credit always comes up. Credit is like a really hot topic that people are passionate and trying to learn about how to improve. So Austin, what are some of the questions that you're hearing from some of your live sessions that you're doing out there? What are people really wanting to know about credit?
That's a good, thank you very much again. And Natalie, Marty, thank you for being on. You both look wonderful. I have a really reoccurring question, especially from my friend Emily. During this COVID time, you're going to a hospital and you have these bills involving medicine, and a lot of the times it's out of your control. This is not debt that you voluntarily taken on. How would you handle that in the best possible way? Exactly.
This is a common thing, very common, where people go to the doctor, their insurance hasn't handled their payments properly, and it's gone into, or now, like, then the client doesn't even know, they're all of a sudden in collection, and they're surprised when you pull their credit report and it shows up at a 623, or like, I paid my mortgages on time, or I paid my car payments on time, but all of a sudden we get like 5 different collections from a medical. It's unfortunate, and it's a situation that there should be some solutions to it, but unfortunately it just stays there until that's been resolved. I would recommend people disputing it, and also recommend involving their insurance companies to resolve these issues as well. But it is a very lengthy process. For us, we unfortunately have to follow what that credit score shows on their credit report, unless we guide the borrower by getting on the phone with them. And I think Natalie and I do this often. We get on the phone with the borrowers and we actually guide them through disputing a process, or like getting a letter of deletion, and or there's ways of doing it. Obviously, if you follow certain protocols, you could probably get something off of someone's credit report. But a lot of clients are not privy to this, and they're not aware and how to approach this. It's intimidating also. Unfortunately, I had a client that just a collector made them cry over the phone, and I was like dying. So it's really, really, they're intimidating tactics and how to collect this information or get the dollars from the clients. So for us, we're going to do everything possible to make sure the clients get these things off their credit report. And if we can't, it doesn't affect them in a sense where we have to pay it back, because our systems recognize their medical collections, and we can exclude medical collections because we understand this is an ongoing situation in the country where people are having to go to the doctor, and unbeknownst to them, the collection agency comes in and puts a collection on until they actually pay off that debt. So yes, it's something we can overcome, and it's also a lengthier process. So get on it right away. Pull your credit and understand your credit, so you can get on these things. Give yourself 2, 3, 4 months for you to be preparing yourself to get these things off of your credit report.
That's a great answer. Karen actually has a question about student loans, right? Medical debt and different things like this is really common, but student loans, Karen, do you want to ask live? You're welcome to unmute yourself.
The reason I'm asking is I have people who've said they have like a $60,000 student loan, $60,000 of student loans that's accumulated, but they also are saying that 30,000 of it is interest, that the actual loans came to maybe 30,000, and then because they've been able to be deferred over the years, it added up. How is it looked at? Because sometimes that may be the only loan, they're paid off everything else. What does that mean?
Go ahead, Marie.
Anybody?
I mean, so as far as student loans go, I mean, it is what it is. I mean, you've taken on the debt, and it's something that's again another problematic situation in the country that the government really needs to pay attention to. I could talk about this all day long, but I do think that it's a problem. But it is what's reporting on the credit report, and a lot of times they don't report the payments on the credit report. So we have to use certain factors to qualify the person. And there's also other ways of qualifying the person as well, because a lot of people use, let's say if you're making very little money at the moment, you use income-based calculations on their payments. So to us, what we're looking for, Karen, is making sure the person qualifies with their monthly obligations, not the overall debt that they have. So you might have a $300,000 student loan, but your payments might be $150 a month. So we really care about, are you going to be able to meet these monthly obligations? So, and in an income-based format, you might be able to qualify for something much lower than a person that's making, a doctor per se, that's working currently, and their payments might be $1,200 a month versus another person that might have $150 a month. From our lending perspective, we just care about their monthly payments. And, if we could help them, guide them to get those on those income-based programs, I'm happy to guide them with that as well too, because some people don't know they have that option. It's about knowledge again.
Yeah.
Thanks.
A lot of people get nervous about, that when they come to me, they're like, I have $150,000 in student loans. I'm not going to be able to qualify. But like Marty said, there are these programs that actually, if they get on this income-based repayment plan, that we can use that amount, whatever that is. And normally, depending on how much they make, of course, because it's income-based, it can be really small. But there are some programs that don't allow for income-based repayment plans, so you just have to structure it correctly.
I wanted to just touch on one part of the question that Karen asked. when she was asking like, how does this affect somebody's credit who has this type of a loan? Well, you could look at your own credit, right? You can go to the credit bureaus and find out what your credit score is. And I would just like to recommend to everyone on this call to do that and to find out what your credit scores are. That's super important to track and to set up accounts at the different credit bureaus and find out where your numbers are at this moment and watch as it changes. So if you have no idea what it is, you're able to find that out for free without affecting your credit and do that. There's also companies like Credit Karma. I know Natalie and Marty say those numbers aren't exactly right, but at least it'll give you an idea of where your score is and what's reported on there, because it will show if you have a lien or if you have a late. You can clean things up on there. So at least it's a gauge for you to watch to see as your score goes up and goes down. But you need to have some idea of where your score is at. So did you guys want to touch on like how people are able to find out what their score is right now, the best way to do that, what you guys recommend?
I think talking to us would be the best way. I think a lot of places don't give you the right scores. And I think the big question that everybody should know is what is the range of credit scores as well? Like I get 900, 1,000 credit scores. The credit score ranges from 350 to 850. It's as simple as that. There's no other algorithms or there's no other numbers. So unfortunately, Credit Karma, and this is yet another, we've touched on 3 problematic situations today. We're talking about medical bills, student loans, and credit scores. Credit scores all have different algorithms, but there is a particular algorithm vendors get from all 3 credit reporting bureaus, which is what we all base our decisions off of. And so Credit Karma may have a different algorithm that might give you your credit scores versus what we get as vendors from Equifax.
So Credit Karma, it says that it's pulling your TransUnion score, your Equifax score, but it's not the same as your Equifax score or your TransUnion score, right? That's what you're saying?
Yeah.
Okay.
I think if I pulled credit scores, it's going to be the same as Natalie pulling the credit scores. We're going to equivocally in the lending industry, it will be the same scores versus when you go to these websites, including mine. I pulled my credit score yesterday for a reason. I needed to pull it. And I have all these services. I have American Express, Credit Karma, and my other, I think it was another company that has it.
Yeah.
And I validated it all across the board.
Annual credit report. Someone just recommended in the chat. The CFPB recommends annual credit report.
And that's the place where you should get your once a year credit report. I think that's a great place to get it. But it didn't match. That's all I'm telling you guys is that all 3 reporting agencies did not, all the 3 sources that I was getting from my own purposes, I was not able to match it to the actual credit score. So,
Austin, what other questions are we getting?
Yeah, Natalie, I wanted to ask you a question because I have a lot of people that are very insecure about their financial situation and say their credit is a little.
Oh, Austin, you're muted.
Not
I
muted.
have a question for you. I have a lot of people that talk to me and they say they're very insecure about their credit history, their financial situation. And I always say that you should speak to a lender ASAP. Why is it good to start a relationship with you when their insecurities are at an all-time low? Do you think it's good to start that relationship soon so you can help better guide them through the process?
Absolutely. Look, the worst that I can say is let's fix it. Let's get it better, and then we can guide them on how. But normally a lot of what happens when somebody comes to me and is like, I'm nervous, I don't want to get started, my credit isn't good. Normally I pull it and I'm like, you're fine. We're going to do this and we're going to do that just so the interest rate is better, but you're fine. And there's nothing like having a real conversation with a lender to build the confidence they need to start looking. And that's kind of what we're here for. You know what I mean? It is shocking how a lot of the time, also like I'll get clients who are married and they'll be like, no, you can't put my husband on the loan. He has horrible credit. And then they want to qualify for something and I need extra income or we need, other ways around. And I'll say, look, I'm going to put your husband on. Let's just see. And sure enough, like all of a sudden the file qualifies for way higher, much more of what they want to purchase, So I think there's like a fear of a credit rating just because people have debt. And we want you to have debt. We just want you to pay the debt on a timely fashion and for a consecutive amount of months or so. Even if people have a bankruptcy, even if people have foreclosures in the past, we can still look at the income, we can still look at the credit, we can still figure out a way to get them pre-approved. It's also important that when people have a lot of debt and they come to us thinking that they're supposed to pay off all their debt before they get started, that's a real misnomer. Like, that simply isn't true. We want you to have debt. We want you to pay it responsibly. We want you to save your money for the down payment and the closing costs, not pay off all of your debt. It happens all the time where people are like, we're ready to buy. We just paid $40,000 off in debt and we have 20 grand for a down payment. And you're like, oh my goodness, I wish you would have come to me before. And I could have said, save the 40. Now we have 60 as your down payment. And we're good with the 40,000 in debt because you earn enough to cover those monthly payments. So people think that they can't have debt, but you're perfectly fine to have debt if the income covers what those monthly payments are. So it is important to speak with one of us so that you can understand where you're at. Let us put you in line and in track for purchasing.
I'd say leave the shame out. Just talk. Don't be ashamed.
Yeah. Exactly.
All right, there's one question in the chat. It says, let's say I want to buy a property and my credit is bad and I have two other partners with good credit. Does my bad credit affect the overall rate I get or how much they're able to qualify for? So how do you get around that? Because I know there's been partners, husband and wife, or I don't know, two people buying a home and one person has a foreclosure and one person has perfect credit. Like, how do you work around that? How does it affect the whole deal? Because I know there's ways, but let's talk about that for a minute.
So it's the worst of, so let's say all four of us on this transaction are all four of us on one transaction. Natalie's got perfect credit score. You've got an amazing credit score, Anthony. Austin, he does, but I have a blemish on my credit score. My credit score is 650, let's say, and all of you guys are at 750. I'm going to be the riskiest person on this loan, and they're going to base, all the lending is going to be based off of my credit score and my credit history as far as the what we're going to base the rate and also the risk levels off of, because I'm part of the transaction. So oftentimes we'll find a way to get the person, possibly to not be part of the transaction and or increase my scores, or at the same time, just deal with it at that point in time, just keep them on the loan. So, but if we can actually, figure out how to increase the riskiest person on the loan is what we could call it. I don't want to use that word risky because that's the word that we use in lending, unfortunately, but it's really what we're looking at is like, okay, there's one person that has the lower scores and, everything's going to be based off of that person's score. So it's very unfortunate because there's three other people that are actually, they're supporting the file. And it's wonderful to have that, but, it's an age-old history of the way of underwriting is looked upon credit. So yeah, I would definitely say, that one person, the husband and wife, really need to one of them needs to basically improve their credit scores and or look at it from that perspective of just keeping them on the credit on the loan as well. So I hope I answered that question properly. That's what I think. We have you on mute, Anthony.
Hey, Natalie, any other advice on that? That's what he asked. Anthony asked if you had any more advice on that. Feed off of what Marty just said.
Not necessarily. No, that's he said exactly. Yeah.
Okay.
A follow-up question. Jamie in the chat, a good friend of ours. I'm trying to rebuild my credit. According to my Credit Karma, my TransUnion is at 569 and my Equifax is at 576. And banks won't even give me a secured credit card. What would the best way to kickstart my rebuilding process fast?
That's tough. If they're not even going to give you a secure credit card, which is how we normally suggest to get started, they can.
Can you explain what a secured credit card is?
Oh, sure. So yes, of course. So you go to the bank at wherever you have a bank account, wherever you hold your money, and you ask them to give you a secured credit card, which means you actually pay them upfront, like $500 or $1,000, and they give you a credit card for $500 or $1,000. And that's a secured credit card. So it's basically linked basically to your bank account. And so, and they'll start a credit card that way. Now, if they're not willing to do that, which is a little odd, normally most of them do, then the best, there's a couple ways around it. So you could ask to become an authorized user on somebody else's card. And then that can help. If somebody or a partner, a family member has a long-standing card that doesn't have a large balance and it's been around for years, that's a great looking trade line. You can ask to become, a co-user on that. And then that can help you at least build up enough to get a couple secured credit cards with the bank. You can also, what I was saying earlier, self-report your utilities. So you can report a gas bill, a utility, a water bill, an electric bill. It's called like telecom self-reported. And so you report those bills that aren't actually loans. And that will also build up your credit. I have somebody who just added that to their credit report and it built their score. It gave them an extra 25 points.
How do you add that? I've never heard of that before.
You have to call the bureaus and then connect the two and add them. I think like Equifax was running a plan for a while saying self-report your utilities and we'll like raise your score by 20 points. And it was like a thing at some point a couple months ago. Did you see that, Marty?
It's called Experian Credit Boost.
Experian,
Google,
yes.
yeah. If you Google that, it should guide you to that. How to do it basically. So just Google Experian Credit Boost, and I think it's only Experian that. I don't know, maybe not. I'm not sure, but like it's So just one of those. Like just go to there, and it'll definitely guide you through it. Basically.
There it is. Yeah.
Okay. Cindy, did you want to ask a question live?
Oh yeah, sure. Hi, Marty. Hi, Natalie.
Hi.
Okay, I have this couple who actually have really, really bad FICO score. They are in the mid 500s. They were thinking about using the dad as the guarantor. Is there any way for them to qualify for a loan?
I mean, they could if they have mid 500s. Would have to be qualifying for an FHA loan. Because that's the only loan program that will go sub 620 credit score. They all go down to 500 credit score, but there are parameter changes. I mean, if you go below 580, so you have to put 10% down. So things of that nature comes into the effect, but they could go low. The question is going to be, Cindy, is why is their score at that level? You can do a loan at 500 credit score, certainly, but there's going to be a little bit of a deeper dive on the credit from an underwriter and understand what happened. Was it a one-time situation where somebody was ill? Was it the death in the family? Was it, if it was negligence of, things that just are just all over the place and they're just not being able to make their payments on time? That's not going to be a good reason for someone to be able to get a loan. So, but it definitely, it allows for people to get a loan, a mortgage with a lower credit score if they had an extenuating circumstance in their life. Something happened in, their scores dropped. The divorce is one of the best examples. It just destroys people's credit for some reason.
The reason why the score is so low is because they had the car repo last year. And also they forgot to pay, I guess they couldn't pay some of the bills like Verizon's and things like this. So how do you fix it?
So fixing it is going to be a different story than, getting a loan, obviously. So fixing it, we're going to have to get into a deeper dive and walk the person through and fix the credit score. And there's not one particular way of doing it. I'm sure Natalie can, agrees to that. It's somewhat of an art form. We kind of have to look at it and understand how, what to do, what not to do. And we have tools at our hands over here too, that we have simulators that we could put the actual credit report in our system and figure out what to do. Like maybe if you, like I've had situations where a borrower have said, you know what, I want to pay off my credit card. I say, no, 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 don't pay it off. Because if you pay it off, it's going to drop your scores down. Oddly enough, I've had situations like that where it pulls your scores down. So what we'll do is we'll play around with that little like, meter and make sure that we tell the person what to do. So it's really hard for me to say what to do unless you look at someone's credit report with, but there's obviously, if they've had late pays, the best thing you could do is you could call and get those late pays removed or dispute them. Disputing is not always the best thing to do because when it comes to our lending, we're gonna say, I don't know, I hope this is not a too lengthy of an answer here, guys, but disputes act like as if the item is not existing on your credit report. So it's almost like you're innocent until proven guilty. So once you dispute something on your credit report, it makes it look like you actually did not have that late pay. It increases your scores temporarily until the dispute is actually resolved. But as lenders, we know that that is a trick that happens. It bumps up your scores. So we, at one point, require you to remove those those disputes off the credit report. So disputing is not always my best advice, unless you have a lengthy period of time, because you really want to get that removed off your credit report. But if it's a short period of time, if we're in escrow on a transaction, I don't recommend people to dispute things off their credit report unless we get on the phone and actually get that resolved right there and then. I mean, Natalie, you might want to add to that. I don't know if there's other things that
Yeah. But I have clients that have like a late payment that shows up and it's wrong, and then they put it in dispute. And it's the same thing. It might be good for them, but it's not great for us, because when something is in dispute, it basically means that the report isn't reporting correctly. It's not taking it into consideration. So our underwriters are basically going to say, well, you got to take it out of dispute so we can actually see what the credit score is, what the legitimate credit score is. So that's
so don't do a dispute too soon of when you need your credit score. Do a dispute many months before and see what happens. Okay. Karen.
And that's why it's so important to have us pull credit and review things so that we have the time to fix it,
Yeah.
But
okay.
Yeah.
Okay, let's get to another question. Karen, you have a question. You want to ask live?
Yeah, what I was going to say is that a lot of times, I think, I don't know if it's a myth, but about, if you take the 3 scores, TransUnion, Experian, and I forgot the other one, and average them, that gives you an idea of where you're at, because sometimes you'll see one will give you 725 and one will give you 800. Does that have any merit at all?
I mean, you don't average them because we will always go off the middle score that the bureaus bring in. So it's 3 bureaus. We go off the middle score. Sometimes only one bureau reports that collection, and now we lucked out. You've got like 780, 790, and 680. But I'm going to use the 790, right? Because I'm going to use, or 780, I'm going to use the middle score.
So the middle score, No
matter what, yes. Now, if 2 bureaus are picking up that collection, and I've got 690, 710, and 780, we're going off the 710. So we don't average the scores, we take the middle, and that's why we have to pull all 3, because different bureaus report different things. And that's why I tell people, they'll come back to me, people are, my credit score is 875. Like Marty said, it doesn't ever get over 850. And in my 16 years of thousands and thousands of credit pulls, I have never seen anyone higher than 825, ever. That's the highest I've ever seen. So when they say 850, I'm like, awesome. I'm going to set an expectation. It's going to come in lower, and don't be sad about it because it's not going to come in that high. But
it's good to know.
It's good to, what's really important is nowadays people are thinking that their credit score is what the bank system online is telling them. So they're like, my Citibank is telling me my credit is 780. And the fact of the matter is Citibank doesn't have their information. They don't know if there's a collection. They don't know. They're not getting that kind of reporting. So
Right.
there's no way for them to know. It's a really terrible way to judge what your credit is.
Are
Actually.
you basically saying no agency really gives you anything accurate, but you guys, lenders have the best system that it's hard to trust any of them, you know?
No, I mean, if you're pulling directly from the bureaus like Experian, or then a lot of the time that is accurate. But again, if
Okay.
you're only pulling one bureau, we don't know what the other ones are reporting.
Mhm.
So bureaus, lenders report
Yeah.
all three. But Marty had something to say, sorry.
Okay, Austin's yawning, so we need to get to another question. We have one in the chat. It's from Miguel, and he's saying, Credit Karma currently reports I have an estimate of 750 credit score. In California, is that a good credit score for a home, or should I wait till I get to 800? Also, what percentage is recommended for a down payment for a home in California? Is it better to have a bigger down or small down payment? Amazing question, 750. Congrats, go ahead, guys.
750 is a beautiful credit score. Anything over 740 really we consider excellent. So, there's not much of a benefit. You're going to have anything above that. There are some very specific loan programs that might provide you with a little bit of a betterment on your rate, but anything 740 or above, you're, sitting pretty basically. So, I mean, and it doesn't mean that anything under that is bad. It just means that you're at the highest level, that anything above that is not really going to, improve it. So 800 credit score, great, wonderful. It's, you should get a medal for that too, obviously, because you've done a wonderful job keeping up your credit, but it's not going to get you anything above and beyond over a 740 credit score, I would say.
Well, I have a good question, because I have a lot of people on TikTok that are, fairly like, from the 18 to 22 area, and they're probably about like a good 30% of our viewers. And they just want to get started on credit in general. I was wondering if either of you had advice on how someone without any history of credit could just start.
The same thing that we said before, go to the bank and get a secured credit card. Maybe start reporting some of your utilities if you can. The bank's secured card is normally how we suggest. And get two, don't just get one, get two, and then build it a little and then get a third. Normally we say that 3 trade lines reports best. One credit card, how hard is it to remember to pay one thing a month? Not so hard, right? But somebody who has like 12 credit cards and pays them every single month and never forgets, number one, that's shocking. Like, I would not want that kind of responsibility, but good for them. Like, that is not an easy thing to do. And the bureaus will reward you for it. If you pay every month and pay well and keep low balances on 12 credit cards, not that I'm suggesting to do that, but I'm saying that the bureaus will reward you. They will give you.
So when you say low balances, under 30% of the maximum, right? That's kind of what we say. So under 30.
What we say. Yeah, on the thirds. Mhm.
So the second part of Miguel's question we didn't get to was, what's a recommended down payment for home loans, right? It's going to depend on your situation. You could get a home loan for 3.5% down, FHA loan, 5% down, 10%, 20%. There's a lot of options. So just know you don't need 20% down. There's a lot of options. Even some people are able to get a loan with 0% down, but 3.5% is pretty standard for first-time buyers. As if you can save up that, you're going to be able to get in the market.
Can I add one more
What else, Austin?
Austin's question for the 18 to 22-year-old group as well, is that sometimes the banks are a little bit more apprehensive. So join a credit union. If your parents have a credit union or someone like that, my background is in the credit union world. And so they might have a little bit of a more lenient way to look at giving somebody a credit card and or unsecured credit card than a bank might. So just, I'm just going to give you that advice as well. Maybe looking into credit unions that you could belong to as well.
And it's completely possible for someone of that age to like hop on their parents' credit history as like an authorized user. That's a thing, right?
It is a thing. It is a thing. I think, but that's not a, sometimes we as lenders don't look at that as valid credit, depending on how much of a loan amount that you're getting. So you really want to build your own credit and not just because we get codes. Everything is coded in credit, and that will get a code that says you're just an authorized user. So we know that that's not truly your credit. we know that when we're looking at it. It's what we're looking is we're manipulating the credit score at that point in time, so we get you a better rate. But when you're actually going to go and apply for a mortgage, you really want to have your own credit built up, not just be all of them is be authorized user. Like if your parents have 3 credit cards, if they've added you on their 3 credit cards, I mean, it's possible to be done, but it's not going to, more than likely, you're not going to get an approval, I would say, just based off of that.
How does bankruptcy affect your credit? And can you buy a house? How long do you have to wait before buying a house if you have a bankruptcy?
So if we're going FHA, you only need 2 years. If you're going Fannie, you need 4, or sorry, conventional loans, which is, you know, the agencies are Fannie and Freddie.
Can I just say ask one thing, Anthony, about that? If you have a bankruptcy, because I've had clients with all the problems we've had in the country, I mean, generally in the past bunch of years, and you can get a house, but it's interesting because you can't get a credit card. You can get a secured, I guess, but nobody will touch you for years with a credit card. What is that? Is that affect anything or?
Reestablishing credit? Is that what you're saying?
Yeah, it's yes, it's trickier. You can, you know, it takes a long time. You can just get a secured card, excuse me, for a while, but some companies make 10 years.
Yeah, you have to be aggressive about it. You can't just have a bankruptcy and then not think that you need to rebuild credit aggressively.
Mm-hmm.
I have a client that had a short sale, you know, when everyone did in 2007 and 2008. Yeah. And by 2009, even less than, it was like less than a year later, he had gotten his score up like 120 points and it was already back to 760. And I remember just thinking, what? Like, how did you do this? And he was ready to buy again. And he was, you know, like, I was like, well, now you still have to wait a little because you just had a short sale. But his credit got up so quickly. And he was just very aggressive about getting it up, getting the secured cards, being smart about it, using his cards that he currently had wisely. Like, it's just, you know, he fixed it. I think he used a credit guy as well. Somebody, you know, who's a professional that helped him.
So we have a couple more questions in the chat. These are actually 2 really good ones. First one, let's go to Miguel. If I were to get a home this year, this is the guy with the great credit. Miguel, good job. If I were to get a home this year, how long do I have to wait to buy my second home? If I plan to live in my plan is to live in the first home, have tenants, rent it, and then get my second home and pay mortgage then. In order to get the best rates, how long do you have to have that first home, live in it, before you can get your next primary residence?
Nobody can tell you where to live. I'm kidding. You know, with 6 months, a year, 2 years, you know, you're supposed to live in the home for at least 6 months. Yes. I've had clients hate the neighborhood and immediately want to buy again. And then we just get an exception for why they're buying, but at least 3 months you have to give it, kind of thing. But legally, you're signing documents that say, I intend to occupy this property. And it is supposed to be for at least 6 months. But, you know, it minimum of that. A year or 2, if you, of course, need to save up money, or depending on how you get your new down payment, you know.
Well, but good strategy to get your house, get tenants, and eventually get into your next house. The next question is an investment question, which is really smart. This one says, does credit matter for buying an investment property, since it'll be an asset of yours and not a liability? And how small of a down payment can you put down on an investment property? That's always my question. I'm like, how can I get my investment property with the littlest amount down? What is it, Marty? Tell me. So yeah, does credit affect when you're purchasing an investment property, and what are the down payment programs for investment property?
So with credit is obviously going to be a part of anytime you're getting a loan, anytime we're giving you an financing. So yes, it's very important that you do it just as much as you do it for your personal residence as well. But as far as down payments go, I mean, it could vary. Investment properties can be a single family to a 4-unit property on the residential world. So each one of these types of properties have variations of down payment requirements. So for example, you could go as little as 10% down on an investment property if you, I apologize, my apologies, it's 20% down on a conventional single family residence. And it could go as little as down to, that's specific to Fannie and Freddie, as Natalie was saying. Freddie does it differently, or you could put 20% down versus Freddie does it a little bit differently. I mean, Fannie does it a little bit differently, but anyway, overall, you could have as little as 20% down on a conventional purchase, is what I mean, on a conventional investment property purchase. If you decide to go into 4-unit properties or things of that nature, it's going to be more down payments, up to 20. I mean, as little as 25% down is what's going to be required.
One little kind of side note to that question, if you wanted to buy an investment property and live in it, that's a different story, because you can get an FHA loan for a 4-unit building and be collecting rent on 3 of the units and live in 1 of the units. Austin always is talking about that on his TikTok videos and lives, and people are loving that and want to do that and want to learn more about it. So if you're going to live in 1 of the units in multifamily property, you can do 3.5% down up to I think 1.5 for 4-plex. Is that right? Something like that.
1.5.
Yeah.
In LA County, it's different for every county, but it is a good strategy. You find a property for under 1.5 million, you live in one of those units, up to 4 units, and you have the other 3 people occupy and rent the units, and most likely, most of the time, it's going to be equal or greater to your mortgage payment. So you might just be being paid to live in your house. It's a great strategy, especially for first-time home buyers who want to invest in property.
My apologies. I thought you were talking about an investment property versus income producing property. So my apologies.
No, you were right, Marty. You were right. The question was investment properties, but I had a little twist on it because, hey, every property is an investment, whether you're buying a condo to live in for yourself or anything, right? But especially when you think of multifamily, as a lot of people don't realize that you can actually buy a 4-unit building and not have to put 20 or 30% down. You could do it with much less down, and even some of the rent that you're collecting helps you qualify for that purchase as well. So it's an amazing strategy. I think if you're a first-time buyer, or you're thinking about buying for the first time, this is a really smart thing to do, and it's something that you should learn more about and ask us about, and run the numbers with Marty and Natalie and see how that could work for you.
Yeah, exactly. Especially if you're in LA. I mean, you're not going to have 4-unit properties for 1.5 million on the west side of LA, like on Sunset Boulevard. It's going to be more towards the 10 freeway, which is an up and coming neighborhood such as Inglewood, Compton, all these neighborhoods that are getting a lot more safe and clean and prosperous, and the citizens that walk the streets are gaining confidence and becoming more financially stable. So the property value is increasing. So if you can hop on that opportunity now, especially in South LA, buy a 4-unit property, live in 1 of the units, yet let the other people pay off your mortgage through their rent. Live in it for 1 year. After the 1 year, you can move out, because that's what you have to do to qualify for FHA. And then you can have that one person of the unit that you lived in rent the unit, and then all 4 units are being rented out, and you can go buy another property where you want. And you have a property of value that's in your name. Wealth creation.
Yes.
Amazing. I mean, this is the only way. I mean, as Anthony always talks about, is how could you make hundreds and thousands of dollars? You can't really save that. You could do it only by buying a place, and all of a sudden it just reaps the benefits of appreciation. So, and it's better than stocks, I think, personally. I'm partial.
I agree with you completely. I get like messages all the time, like, show me a 4-unit property in LA and I'll buy it. And they say it as a joke. And then I send them a picture of all the properties that are available that are under 1 million or even 1.5 million. And I'm like, okay, take your pick. You're going to buy it. And they never buy it because they didn't believe that those properties are out there, but they are. And the strategy is very, very useful for someone, especially my age, to have their first property purchase and build wealth along the way.
So we have a lot of people looking, like really smart people on this call, looking to invest and get second homes. We'll do this question and then maybe one more, and then we're going to wrap it up. But when you get a mortgage, does that improve your credit score, or does that bring it down because you have a new giant debt? Up. Over time, it goes up. Yeah, so that's going to help you again qualify for your next purchase. So good question, good question. Anybody else? Final question of the day.
Well, I just wanted to add that to tell young people that when they buy a fourplex, that they also should consider that those other 3 rentals will be added to their income, a percentage of them, not the whole amount. Is that correct, Natalie or Marty? So that's something to also consider.
Absolutely.
Parents, you're as young as us. Why do you refer to us as young people?
Younger than me. Sorry about that.
Beautiful. That's better. Much better.
Okay, sorry. Or younger than everybody on the panel.
Yeah.
Anyway, but that whole idea that they can use the rental as income as well, not just that it's paying off the mortgage. It helps them buy the property. Is that correct?
Yeah, absolutely. We structure people with lower income all the time into units to help us qualify.
Mhm.
Yeah, it's anytime you could do 2, 3, 4 unit properties, I'm all for that. I think it's wonderful, and LA is geared up for that, and there's plenty of those types of properties in Los Angeles. So as Austin said earlier, it's definitely there. It's not out of reach, and that income is used to qualify you, which is even better. I mean, you don't have to use your income only to qualify for a 4-unit property, but that additional, rents that are coming from the other units are going to help you qualify as well. And it's just, someone else is paying your mortgage, just like you are paying right now. If you're paying rents, you're paying someone else's mortgage right now. So
Exactly. Guys, thank you guys so much, Marty and Natalie, for being here. This has been really, really helpful. Everybody, thanks for attending. We have 2 more seminars on our books so far. Our next one is March 4th. It's going to be all about what to do before you sell, because the first question that we ask is there any way you could keep this property and buy something else without having to sell it? So we'll talk about those strategies. We'll talk about rehabbing your home before you sell it. Everything you need to know before you sell to make sure you're gaining and preserving most wealth as possible. And then on St. Patrick's Day at 11 a.m., we have Investing 101. So everything you need to know about investing, cap rates, GRMs, expenses versus income. If you're looking at a fourplex, what should the income look like in that fourplex that you're bringing in compared to the purchase price? And we'll talk about all of those types of basic things. So those are all coming up. Plus, check out all the resources we have on our collective YouTube page. It's thecollectiverealty.com, and our YouTube page is just search The Collective Realty. Follow us, like us. Thank you guys for your support, and we look forward to seeing you on our next call. Have a great evening, everybody.
thank you, everyone.
Bye.